Hi, in this video, I'm going to talk about the role of central banks in controlling the Forex market. In my previous video, I think I did a video tackling the top 5 economic indicators that traders should pay attention to. And one of the things I highlighted was the role of understanding interest rates and central banks. And that has brought in a lot of questions, and I want to expound further on the suggested topic. So, what roles do central banks have in controlling the forex and currency markets? In order to understand this, we need to first understand what role does the central bank have in regulating the economy, or rather, what is the mandate of the central bank? And the central bank has two main mandates. The first one is to maintain inflation levels at levels that are normal or good, and the second one is to keep employment at full levels, making sure that the economy is strong enough so that jobs are available for people. Now, those are the two main mandates that the Federal Reserve, let's say, which is the main central bank in the American economy, is responsible for. And this cuts across most central banks, including the European Central Bank that governs Europe, the Bank of Japan that governs Japan, the People's Bank of China that governs China, and probably even the Central Bank of Kenya, which governs our economy. However, they don't have a set of many tools, or they don't have infinite number of tools for them to do this. They have very few tools. The first one being monetary policy, which is basically about interest rates. At what level should we lend money into the economy? Should we make it harder for people to get loans, or should we make it easier for people to get loans? The second one is open market operations. This is the bond buying and bond selling programs that you'll often hear taking place in the central bank. A bond is basically a promissory note to give you your money back at a coupon. So when the bonds being offered into the market, it means the central bank is putting money into the economy. But when they are buying bonds from other people, it means they are taking money out of the economy. So there is the bond open market operations. And then the final one that they have is devaluing currencies through pumping money. Like, for example, if you look at the Bank of Japan, if you look at the European Central Bank, sometimes they've devalued their currencies specifically with an aim of making the economy stronger, or with an aim of saving themselves from a recession. So those are the main mandates that the central bank will have. Okay. So how does this affect the Forex market? Okay.
Hey guys, we're taking Forex education to the next level. Join us every week for live exclusive webinars where we break down market insights and trends, fundamental analysis, market sentiment, pro strategies that we use here at Financial Hub, and live Q&A sessions with us. Whether you're a seasoned trader or a beginner, this is an opportunity for you to learn, grow, and trade smarter, all free thanks to Pepperstone. Next session drops soon. Stay tuned and don't miss out.
1. If you really want to understand the central bank and how they govern, they normally have structured meetings that take place every month. We'll have a meeting that will take place, or every 6 weeks to be precise. So for example, if you just come to my screen, you can see this is the Federal Reserve. So Board of Governors of the Federal Reserve. So they have a YouTube channel. And you can see that the last meeting they had was on January 29th, 2025. And after a meeting and they announced their decision, they will often have a press conference where they will share what they expect the economy is doing, what decisions they are likely to make, and they somehow give the guidance on the path forward, on the economy, on the path forward, on the policies that they'll be implementing. If I switch tabs here, you can see the European Central Bank also. They have their own YouTube channel, and they also share their remarks on what policies they're likely to implement, why they're implementing those policies, and why they think certain decisions are the best, whether it's hiking rates, lowering rates, or offering bond buying programs. I'm sure if you look for Bank of Japan, you'll get one. If you look at People's Bank of China, you'll also get a channel, and many other banks. Now, once the central bank has decided to either lower or hike rates, it's likely to affect the currency depending on what is happening in the country at that particular time, depending on traders' sentiments based on what the central banks are doing. Because remember, for markets to move, it's a fusion of two things. There has to be a reason or a why, which is mostly a function of policies, but there also has to be the belief that a particular thing will lead a particular thing to either be expensive or not expensive. For example, any time where there is high inflation, you will often find central banks hiking rates or increasing interest rate levels. So if interest rates are at 5%, you might find the central bank taking interest rates to 6%, 6.5%, 7%. For example, during 2021, after COVID crisis came along, if you look at the economic indicator of interest rates in the US, which I'll open for you a chart for you guys to see, interest rates were rising all the way from about 0.2 to trade as high as 5.5, which was the peak of interest rates. Let me just share with you. So let's look at the 3-year data. Yeah. So if you look at this time, from around March of 2022, there was high inflation in the US. So inflation was very, very high due to the amount of money that was pumped into the economy during the COVID crisis. And you can see between March, interest rates started moving higher from March 18th at 0.5. The next meeting we had was on May 4th, where we had a 50% basis increase, or a 50 basis points. We got to 1%. We got another 75 basis points, which brought us to 1.75. We got another 2.5. We got another 3.25. We got another, from 3.25 went to 4, 75 basis points. Then we went to 4.5. We went to 4.75 in February of 2023. We went to 5 in March of 2023. And we finally topped around July 2023 at 5.5. And between July of 2023 to September of 2024, rates stayed at 5.5. And in September, we had a decline from 5.5 to 5, which was the first one. We stayed there again. In November, we had another 25 cut, which brought us to 4.75. We stayed there again. And then recently in December, we got another small cut, okay, from 4.75 to 4.5. And now we've been at 4.5 for quite a long time. Now, if you are paying attention to that, I want you to just observe what the dollar did during the specified time that we're talking about. So let me just share with you the chart for you to see what the dollar did during the specified time. So these are my charts, and any time where you're looking at fundamentals, you could also compare the output you're getting from fundamentals to what prices did historically. Now let's look at it from a weekly perspective, and we want to pay attention from around March of 2022. What did the dollar do all the way to around July of 2024? And if we come back, this is July 2023. Yeah, so if you are paying attention, you'll see that from around March 2022, the dollar started moving higher from around, let's say January, we had 95, and we moved higher from 95 all the way to 112.5 in September of 2022. So this move was way, way faster than the interest rate moves. And the reason for that is because markets are always ahead of reality. So markets or traders' expectations will fuel prices higher before even some economic realities come along. And by the time prices topped in September of 2022, we were now moving from a rate hike cycle, and we would now start having a decline again in rates. So you can see clearly that anytime in a currency we have expectations of higher interest rates, or the Fed is moving towards hiking rates, we can expect that currency to appreciate in value. But any time where we have the opposite scenario taking place, whereby we expect the Feds to start lowering rates, we can expect the currency to start declining. Like right now, if you look at the dollar, we've just started the move lower. We started, I think, in September of 2024. And now you can see clearly the dollar is somehow in the process of declining a bit. We had a move higher from around 100 before this decline, and this one was mainly factored in because of the Trump trade, the tariffs that will bring along. So remember also the stock market is a complex game. It's not only interest rates that are factored into how these things move. We also have other factors that come along. For example, policies that are being implemented by the government, the sentiment, relativity to other currencies. Those things also play a role. But for today, we were just looking at how central banks and hiking rates and lowering rates is likely to affect a currency's value. Now, in some countries like Japan, you'll often see the central bank generally devaluing their currency. And this is with an aim of trying as much as possible to favor things like trade and to also make it a little bit better for the economies through currency devaluations. So you could also look at to how currency devaluations are likely to affect the currency exchange rate, why central banks do it, how central banks go about devaluing the currency. There's also another big loophole which we can look at in another video. But today I wanted to introduce you to the idea of central banks and how they affect the exchange rate that takes place in the market. So with that said, we'll catch up in the next one. Peace.